Hello Lana, welcome to Manifested Online platform. My name is Joseph Kemani, and I want us to continue with our topic number 3. And in that topic number 3 in financial statement analysis, the topic is 3, that is quality of earnings. Quality of earnings earnings and earning management. Now, in this particular topic here, we are going to look on various subtopics, and maybe we can first of all highlight those particular subtopics which we are going to cover here. One, we are going to look on the various categories of earnings. Or in this case, you're going to look on the various categories of profit, because we talk of various types of profit. 2, we are going to look on the subtopic of the earnings per share, which is governed by IAS 33. We're also going to look on the other topic of segmental reporting, or what is known as operating segment, and this is governed by IFRS 8. And then finally, we're also going to look on the last subtopic to do with earning management. So those are basically the 4 subtopics which you're going to cover in that particular topic of the quality of earning and earning management. We start with the first topic here, the first subtopic of the categories of earnings, earnings. Now, in this case, when we talk about what we refer as earnings, this is what in other terms we refer to as the profit. Now, in this case, we do have various categories of profit, or basically various categories of earnings, which you need to know before now we can proceed and basically look on the other subtopics. So the first type of profit or earnings is what is known as interest. That is earnings before interest, tax, depreciation, and amortization. That is earnings, which is before interest. Interest is what in other terms we refer to as the finance cost, tax, depreciation, and amortization. Meaning that this is now the profit of the company, which is computed after deducting all the expenses, but we exclude the interest, we exclude tax, we exclude depreciation, and also we exclude what? Amortization. This particular profit here, or this particular earnings, it is very useful in terms of evaluating what we refer as the company's performance. Means that if at all then we intend to measure the performance of a company in respect now to the other companies, so basically we want to do what we refer as the cross-sectional analysis, that is comparing the performance of the company with the other companies. Then this is the profit, or basically the earnings, which is recommended. The reason why we say this profit is the one which is recommended is because this particular profit here will be excluding depreciation and also amortization, which is based on the accounting policy adopted by what? By an entity. Remember, one of the challenges which is faced by the companies whenever a comparison is to be done with the other companies is as a result of entities using different accounting policies. But once now we have excluded depreciation and also amortization, then in such a case we can then be able to perform what we refer as cross-sectional analysis in terms of comparing the performance of the company with other companies. And that's why we have said this particular first category of profit or earnings is very, very important in terms of comparing the performance of the company. Now, the other category of earnings or the other category of profit is what we refer to as operating profit, or what in other terms we refer to as operating earnings. Operating earnings. And this operating earnings or the operating profit, this is what in other terms we refer to as the profit before interest and tax. Before interest and for this particular component, very what refer is useful in companies profit, companies BDT. This is because this particular profit here, it has taken into account most of the component of cost, or most of the component of what of the expenses, now excluding interest, what in other terms we refer to the finance cost. Then the other component of or the other category of interest which we have is what is known as the net income. Now, the net income, this is what in other terms we refer to as the profit after tax, or what in other terms we refer to the profit for the year, for the year. So therefore, what you need to note is that when talk about now the net, referring to the profit tax, or the profit for the year, talking of one and the same thing. Now, this particular earnings here, or this particular profit here, is useful or is used by the company whenever a company is computing the earning per share. So mean that whenever now the earning per share is to be computed, that is EPS, then in our case we use this particular profit. And because that is our second subtopic to cover, we are going to look on how we compute the earning per share using now the net income. And therefore, what you need to note is that the net income here is the profit for the year, basically the profit of the company after tax. So therefore, those are the three main categories of earnings, or the three main categories of profits, which definitely you need to be aware of. Now, once now we look on that, I want us we proceed and we look on this topic here of the earning per share, which is a very common topic in the exam. So we look on earning per share, which we have said is governed by IAS 33, earnings per share, per share, which is abbreviated as EPS. Now, in this particular topic here, this subtopic, we are going to look on a number of issues. One, we are going to look on the definition of earning per share. Two, we are going to look on the types of earning per share, earnings per share, which need to be computed, disclosed by an entity. Three, we're also going to look on the computation of those two types of earning per share. Basically, we're going to look on the computation of basic earning per share and also diluted earning per share. And also we are going to look on some of the criticisms, or basically some of the disadvantages of earnings per share. We're going to look on the disadvantages of earning per share. And also lastly, we are going to look on use of EPS in a firm valuation, or in valuation of a firm, a firm. So therefore, those are basically the various areas which you are going to cover as far as that particular topic of earning per share is concerned. I want us to start with defining what is earning per per share as defined under IS 33. Now, when talk about earning per share, abbreviated as EPS, this is defined as the amount of earning or the amount of profit which is attributable to each ordinary or to each equity share issued by who? By the company, meaning that the earning per share is the amount of earnings or the amount of profit which is attributable to each ordinary share, also known as equity share. So that is the definition of that. Now, according to IS 33, that is International Accounting Standard number 33, all those companies which are listed, when talk about a listed company, you're talking of a company whose shares are trading in the securities exchange market. Now, those particular companies, they are required to compute and disclose the earning per share. So, mean that all listed companies, they must compute and disclose. All listed companies must compute and disclose earning per share. And in this case, when talk about disclosing, what you have to remember in the lower level in financial accounting, you looked on the component of the financial statement, and those components are 5. One, we have the income statement, statement of financial position, statement of changes in equity, statement of cash flow, and the note. Now, the earning per share which is computed by the company, it has now to be disclosed as part of the note to the financial statement. Now, in this case, we do have two types of earnings per share, which now a company should compute and disclose as part of the note. So the first type of earning per share is known as the basic earning per share, and number 2, we do have the diluted earnings per share, and basically these are the two types of earnings per share which you are going to cover in terms of how they are supposed to be computed. I want us we start with the first one, and that is the basic earning per share. Earnings per share. Now, when talk about this particular earning per share or this EPS, we say it is an earning per share which is computed based on the shares which are issued and free paid as at the end of the year. And in terms of how we compute this basic earning per share, we take the earnings which are attributable to ordinary shareholders of the company, and then we divide that with the weighted average number of ordinary shares, and we abbreviate that as WANOS. WANOS stand for weighted average number of ordinary shares. So therefore, for us to compute that, we use that particular formula. Now, in our case here, there are a number of or basically there is something which is very, very important which you need to note. One, when talk about these earnings which is attributable to ordinary shareholders, this is computed by taking the profit after tax. Remember, in our case, or here we have said that when talk about now the profit after tax, this is what in other terms we refer to as the net income, and then to that profit, then we have to raise the preference dividend. So mean that to compute now the earnings attributable to ordinary shareholders, we take the company's profit after tax. This is what in other terms we have referred to as the net incomes. So once now we have that profit there, we less the preference dividend. The preference dividends We also refer to that as preferred dividends, and the preference dividends which we raise here should be the preference dividend for the current year. Now, once we deduct that from our profit here, whatever we get here is known as the earnings or the profit, which is attributable to the ordinary shareholders, shareholders. So that's how we compute that item there, known as earnings or the profit attributable to ordinary shareholders. Now, once we have computed that, we then proceed and we compute what is known as one-offs, that is weighted average number of ordinary shares. Now, in terms of how we compute this, first of all, we take the ordinary shares, that is the number of ordinary shares which were issued and free paid, as at the start of the year. That's why we talk of the balance brought down as at the start of the year. And then now to this, we are supposed to add the shares which are issued in course of the year, meaning that we add shares issued in course of the year. Now, these particular shares which are issued in course of the year are usually broadly classified into two categories. One, we do have those shares which are deemed to be issued at full market price. Now, when talk about shares issued at full market price, these are those particular shares which an entity or a company will issue in course of the year at a price which is equivalent to the market price. Now, those shares, for the purpose of adding them there, we are supposed to weigh them on time basis for the period they will be outstanding during that particular financial year. What that means is that if a financial year of a company start on 1st of January and end on 31st of December, and maybe you're told on 1st of July. 1st of July now should be 6 months to the end of the year. So if at all we are told that the company issued a number of shares on that date, like maybe let's assume you are told the company issued 2 million ordinary shares. Now what we know is that the holder of those shares will only be holding them for a period of 6 months during that year. Now those shares, for the purpose of adding them here to the shares issued and fully paid at the start of the year, we don't add them as 2 million. Rather, in this case, we are supposed to weigh them on time basis for the period adding that here. So what that means is that when adding those particular shares here, we should take now the shares issued 2 million, and then we multiply them with the proportion of time they will be outstanding that year. The proportion of time they will be outstanding should be 6 months all over 12 months. In such a case, then we say that we have weighted them on time basis. 2, those shares which are issued in course of the year, they are those shares which are deemed to be issued at nil consideration. Now, when talk about shares issued at nil consideration, these are those particular shares now the company will issue in course of the year, but without additional resources. Now, a good example of this is what we refer as a bonus issue. When talk about a bonus issue, this whereby the company will issue additional shares to the existing shareholders of the company free of charge. Now, those shares which are issued during the year at nil consideration, they are assumed to have been issued at the start of the earlier period reported. What that means is that if we are computing the earning per share for the year 2018, and also we are given information about 2017, those shares which are issued in course of the current financial year at nil consideration, they will be assumed to have been issued at the start of 2017. As a result of that, 2 things. 1, these particular shares, for the purpose of adding them to the shares issued and fully paid at the start of the year, we don't weigh them on time basis. 2, we also use those particular shares in terms of restating, or we use those shares to readjust the earning per share for the previous year. Maybe in the question or in the illustration questions which you are going to do, I'll illustrate more in terms of how what we mean by restating or adjusting the earning per share of the previous year. So therefore, when computing this particular one-offs, weighted average number of ordinary shares, we take ordinary shares, and that is the number of ordinary shares issued and free paid at the start of the year, and then we add those other shares which are issued in course of the year. Of which I've said that shares issued in course of the year may be classified into two: shares issued at full market price, which you have said should be weighted on time basis, and shares deemed to be issued at nil consideration, which should not be weighted on time basis. And then we add oath, and whatever you're going to have there will be our one-offs, one-offs. And this is now what we use in terms of computing what we refer as the basic earning per share. Before we look on specific treatment of the shares issued in course of the year, there is something here which is also very, very important, and which as a student you need to note. When computing these earnings or the profit which is attributable to ordinary shareholders, there is some cases whereby you can be told to compute the basic earning per share for the group, for a group of companies. So therefore, if now you're given such a case whereby you're required to compute the earning per share or the basic earning per share for a group, then this particular profit after tax which we use here should be the profit which is attributable to the members of the group, of the group. So mean that when computing group basic earning per share, group basic earnings per share, we use the profit after tax, or the profit for the year, which is attributable to the parent entity, That is very, very important, especially when we are to compute now the group earnings per share. Now, I want us to look on the specific treatment of the shares issued in course of the year, or basically what causes changes in the number of shares. So let's look on what causes changes in number of shares. Remember here, we have said that to compute our one-offs here, we take the shares issued and free paid, that is number of ordinary shares issued and free paid at the start of the year, and then we add the other shares issued in course of the year. Now I want us to look on the specific treatment of how of the shares issued by an entity, or basically by a company, in course of the year. One, we do have a issue at full market price, market price. Now, when talk about issue at full market price, this whereby the company will issue additional ordinary shares in course of the year. Now, what you have said there is that those shares issued at full market price, they will be weighted on time basis for the period they were outstanding in course of the year. So therefore, these shares issued at full market price should be weighted on time basis. So these shares should be weighted on time basis, for the purpose of computing, computing one-offs, and that means that if now we are given a case whereby we are told that the financial year of the company start on 1st of January and end on 31st of December, and maybe you are told on 1st of maybe September during that year, 1st of September, that is 3 months to the end of the year, because we have September, October, November, December. Sorry, we have 4 months there. If we are told that the company issued 5 million shares there, for the purpose of computing our one-offs, that is weighted average number of shares, these shares which were issued there, we don't add them to the shares issued and fully paid at the start of the year is 5 million, rather in this case you are supposed to wait them on time basis for the proportion of time they were outstanding during that year, meaning that we take 5 million times 4 all over 12. 2, we have what we refer as issue of bonus shares, bonus shares. Now, when talk about bonus shares, these are the shares issued to the existing shareholders of the company free of charge, meaning that the additional the existing shareholders of the company will receive additional shares which then they are not required to pay for. Now, these particular shares which are issued by the company, and the company do not receive any additional amount of money or additional resources. One, we have said that they are assumed to have been issued at the start of the earlier period reported, meaning that these shares are assumed. These shares are assumed to have been issued at the start to have been issued at the start of earlier reported period. That is very, very important. Now, as a result of this, or before we look on that, assuming we are to compute now the basic earning per share for 2018, and also we are given some information about 2017. Now, those shares which were issued during the current year, that is 2018, at nil consideration, then they are assumed to have been issued at the start of 2017. As a result of that, these shares, one, they are not weighted on time basis. They are not weighted on time basis. They are not weighted on time basis. For the period now they will be outstanding during that financial year. 2, these particular shares, and we use them to restate or basically to adjust the earning per share of the previous year. So they are also used. They are also used to restate earning per share of previous period or the previous year. That is very, very important, that those shares which are issued free of charge to existing shareholders, because they are assumed to have been issued at the start of the earlier reported period, we don't weigh them on time basis. And 2, we also use them to restate the share of the previous year. Then from there we have a issue of shares on conversion of convertible debentures, convertible preference shares, or convertible loan stock. Now, in this case, when we talk about this convertible financial instrument, e.g. convertible debentures, convertible preference shares, and convertible loan stock, these are financial instruments whose holder do have the right to be able to convert them into ordinary shares. In the moment now we have ordinary shares issued by the company on conversion, then in this case those shares are treated as shares having been issued at full market price, and therefore what we do is that those shares issued on conversion, we are supposed to weigh them on time basis. So mean that here ordinary shares issued on conversion, shares issued on conversion should be treated as an equivalent, equivalence of issue at full market price, at full market price. And therefore, what you need to note is that once now we have ordinary shares issued on conversion, we are always supposed to weigh them on time basis. The reason why we say we treat them as equivalent of issue at full market price is because when the holder of the debentures or maybe preference shares or their own stock were issued with those convertible securities, they paid for them. So therefore, we treat them as shares which were issued at full market price, and definitely we need to weigh them on time basis. Now, the other reason as to why a number of shares issued and fully paid at the start of the year may change is as a result of issue of partly paid shares, shares. Now, in this case, when we talk about issue of partly paid shares, these are those shares, ordinary shares issued by the company in course of the year, but at the end of the year, those shares will not be fully paid. Now, for the purpose of computing our one-offs, we are supposed to compute the proportion of shares deemed to be fully paid, because those are the shares which will be entitled to dividends by the end of the day. So therefore, in respect now to these shares, we are supposed to consider the shares which are fully paid, and those particular shares which are deemed to be fully paid, in terms of how we compute them, we take now the amount received by the company, and then we divide that with the issue price. Price. So, for example, if we are told that the company or the financial year of the company start on 1st of January and end on 31st of December, and maybe you're told on 1st of July, the company issued like 5 million ordinary shares, 5 million ordinary shares, and the shares were issued at a price of 80. At a price of what? 80. But equally, we also told that at the end of the year there, the amount now which had been paid per share was 40 shillings. So what that means is that because the shares were issued at a price of 80, but at the end of the year the only amount which has been paid per share is 40, then those shares are partly paid. Paid. So what we are supposed to do for the purpose of computing one-offs, we are supposed now to consider the shares which are deemed to be fully paid. In terms of how we compute that, we are supposed to compute the amount the company received from the shares issued, which in our case here will be given by the shares issued, which is 5 million, and then we multiply that with the amount now which has been paid per share as at the end of the year. So in our case, we are told the amount which has been paid or which was paid per share at the end of the year was 40. So that now will give us the total amount the company had received from the 5 million shares which were issued, and then we divide that with the issue price, which is 80. So once now we divide that with 80, then what we are supposed to do is, because the shares were issued then at full market price, we are then supposed to weigh them on time basis. So taking into account they were issued on 1st of July, so here we have 6 months now to the end of the year. We are supposed to weigh them on time basis for the period they were outstanding during that year. So therefore, in case of shares which are issued in course of the year, but at the end of the year they are not fully paid, what we are supposed to do for the purpose of computing one-offs, we should consider those shares which are deemed now to be fully paid. Now, the other reason why the shares issued and fully paid at the start of the year may change is issue number 5 is issue of shares in exercise of a stock option, options. Now, first of all, when talk about what we refer as a stock option, we say that this is a right now which is given to the employees of the company to be able to buy the shares of the company in future at a price below the market price. So mean that stock option is a right given to the employees of the company, employees of the company to buy shares at a price below the market price, below market price, of which now that price at which now they buy the shares of the company at, then in this case we refer to it as the exercise price. Now whenever now the employees of the company exercise this right in terms of now buying the shares of the company, then they will buy the shares of the company at that price which is below the market price. Now ordinarily whenever now the shares of the company are issued at a price below the market price, then some of the shares are deemed to be issued at full market price, whereas other shares are deemed to be issued or they are deemed to be issued at nil consideration, or they are deemed to be issued for free. So therefore, anytime now we have shares which are issued to the employees of the company at a price which is below the market price, so what we need to do is to split the shares into two components, into shares deemed to be issued at full market price and shares deemed to be issued for free. Now in terms of now how we split those shares issued to the employees of the company once now they exercise their stock option. One, to compute shares deemed to be issued at full market price, price, first of all we compute the amount of money received by the company, by the company, of which now the amount received by the company here, this is computed by taking shares issued to the employees of the company times the exercise price, price. So that now will give us the amount, and then we divide that with the market price per share, price per share. Now that will give us the shares then which were deemed to be issued at full market price. Now once now we compute these particular shares deemed to be issued at full market price, for the purpose of computing a weighted average number of shares, these shares should be weighted on time basis, because these are shares deemed to be issued at full market price. Then from there we compute the bonus element. Now when talk about the bonus element here, we are talking of those particular shares which are issued now to the employees of the company but free of charge. Now in terms of how we compute this, we take shares issued by the company to the employees, and then we deduct the shares deemed to be issued at full market price, price. So that's how we compute the bonus element. And because these shares is a bonus element, or basically these are shares deemed to be issued at nil consideration, these particular shares, what we have said from what we have covered here is that these shares should not be weighted on time basis for the period they will be outstanding during that financial year. So therefore, those shares issued to the employees of the company, once now they exercise the stock option, then those shares are ordinarily split into two: shares deemed to be issued at full market price and the bonus and the bonus element. And then from there we do have what we refer as the issue of shares as a part payment of a purchase consideration, in a business combination. Now first of all here, when talk about a business combination, this is a process through which now one entity will acquire all shares in another entity. For example, a case whereby maybe company P can buy some shares in company S. Now, that process we refer to it as business combination. Now, once now that company buys some shares in company S, it is required to pay a price known as purchase consideration. Now, whenever this company is to pay the purchase consideration, it can pay that in cash, or it can pay that through what we refer as the share exchange, through share what? Exchange. Now, mean that if now this company pays that purchase consideration through share exchange, then it is required to issue shares. It is required to issue shares to pay the purchase what? Consideration. Now, those particular shares which are issued to pay the purchase consideration, we treat them as shares, or we treat them as an equivalent of shares issued at full market price. So mean that those particular shares then, one, they must be weighted on time basis, must be weighted on time basis, weighted on time basis, on time basis. And number two is that those particular shares will be considered from the date the acquisition take place. The reason why we need to note that is because there are some cases whereby you can be told, for example, the acquisition took place at the start of the year, maybe on 1st of January, but maybe the shares were issued later on. The shares were issued later on, for example, on 1st of July. Now, those shares which are issued to pay the purchase consideration, we consider them from the date of acquisition. So, mean that the shares are considered, shares are considered from date of acquisition, and not from the date of issue, and not from the date of issue. That is very, very important. So therefore, we do have that is the other reason as to why the shares issued and fully paid at the start of the year may change. So first of all, I want us, we take a short break, and then we come back. We still look on the other reasons as to why now the number of shares issued and free paid at the start of the year may change, whereby we are going to look on a aspect of what if as a right issue and so on. So let's take a short break, and then we come back. We look on the other aspect.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.
Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Ngwiri. I'll be taking you through equity investment analysis, and the topic that we're looking at is technical analysis. In today's lesson, we are going to look at the following. So we are going to look at, the first thing we're going to look at is primary trend. Then we will move on and look at secondary trend. Like that. Then we will move on to minor movements, like that. And these are the principles that underlay the Dow theory: primary trend, secondary trend, and minor movements. Then we will look at the interpretation of trend lines. Interpretation of trend lines, like that. Now here specifically we'll look at uptrend, that. Then we will look at the downtrend and no trend. Downtrend, trend, and no trend, like that. Then we will move ahead and look at the prediction of the market using the Dow theory. Prediction of the market using Dow theory. That. And then we move ahead, we'll be looking specifically at the Dow Jones Industrial Average and the Dow Jones Transportation Average there. Moving on, we will look at the support and resistance level. support and resistance levels, like that, and try to explain the reasoning behind the support and resistance levels. Then we move ahead and look at chart patterns. Yeah. Then we'll move ahead and also look at the reversal patterns. Reversal patterns. And finally, we will look at the trend lines. Trend lines, like that. Now, this is what we will look at today. And we start off by looking at the primary trends. Primary trends. Yeah. Now, the primary trends, as explained in lesson 1, we had said that the Dow Jones, the Dow theory is governed by 3 trends: the primary trend, the secondary trend, and the minor movements. And I will be able to demonstrate the primary trend as follows. So we will be able to draw how the primary trend looks like and we'll try and superimpose the primary trend, secondary trend, and the minor movements on one graph, like that. So here we have increasing, like that, the prices. Here we have time, like that. So if we have the primary movements move in form of trade. So this is the security price that is moving like so. For example, it's moving like that upward direction, bullish trend. This is now moving up. Bullish means that it's moving up. Bearish means that it's moving down, like that. So trying to explain the primary trend, it is in form of waves, rather tides, like that. So that is an indication of a bullish trend based on the primary trend. How different is that bullish trend from the primary trend from the secondary trend? Now, the secondary trend is a movement in smaller patterns, like that. So it just follows the primary trend, but now in smaller, what we can be able to call them as smaller waves, like that. Superimposed on this, we can be able to explain the minor movements. So the minor movements now follow the trend, the general trend, but now in smaller, what you can say, smaller movements. That. So you're moving like that. So the primary trend is the bigger wave that moves like that. I can be able to demonstrate right just below this. This is the main graph over here that we're looking at. Wait, you have superimposing, and you have the primary, secondary, and tertiary trends superimposed on each other. But now, trying to explain the primary trend, this is still prices, like that. Here is time, like that. So we can be able to just explain now the primary trend, because that is the major topic that we've actually talked about over here. So if the security price is moving like that, so you can say that this represents primary trends. You can say this is A, primary trends, like that. That is what we have looked at there. B, say this is A, now this is B. Secondary trends. So the secondary trends move in smaller prices, time. So if you have now, we can be able to use bearish trend, like that. This is bearish trend, like that. So we can be able to say now they're moving in small waves, like that. This is what we're saying is a secondary trend. It's much smaller as compared to this one. You can see this one is much bigger there. This one is much smaller there. See, so you can say you can use this B secondary trend line, but here is primary trend line. So you can be able to see it like that, and this is the primary trends like that. Now we can be able to now draw finally the minor movements. Prices, you can put this right here. We have prices. Here we have time. So we can be able to say, if we don't have a trend, we can give another description over here. If the prices are moving somewhat like that, over here we can have very small movements like that, which are indicative of a minor movement. So here we have C minor movements over here, and we have minor movement line, C minor movement line, like that. Now, having looked at the primary trend, now here we have the primary trend. This is the major line, here is the primary trend like that, and we are saying that this is now the big tide over here. This is the wave, and this is the minor movement. We can move on to interpretation of the trend line. So you look at the primary trend, the secondary trend, and the minor movements there. Now we move on to look at the interpretation of trend lines there. So let's look at that very quickly. We have interpretation of trend lines. Interpretation of trend lines. Interpretation of trend lines. Now here, more specifically, we had said an uptrend, a downtrend, and a no trend over here. And so we are saying in an uptrend, we can show it like this. So if we have prices moving like that, this is prices, this is time here, we can be able to draw a line like that. As well, we can be able to also draw a line like that, and this is an uptrend, bullish trend, like that. Now this is an uptrend, so once you see security prices moving in that direction, generally they, of course, you don't expect them to move like this. In practice, you might expect them to move somewhat like that, not very straightforward lines like that. This should be indicative of an uptrend like that. However, so you can say this is an uptrend, A here, uptrend like that. B, we have downtrend, downtrend like that, and we draw a downtrend like so. This is prices, this is time. So downtrend moves now the opposite of, and then we can be able to probably draw what we can call a channel like that. So that one doesn't, not very perfect. It's good to be perfect sometimes, not all the time, but you can try that. So that is a downtrend, what we can call bearish. trend there. Now, a no trend is where the market moves in a fashion that does not indicate, or in a way that does not provide any indication of a trend. And I will demonstrate that shortly. Where we have, like so, we can use this to make sure at least we are accurate, almost accurate. Time, that. This is prices. That. So we're saying if trend moves like that, then we don't have any movement in any particular direction. It's neither is it moving in a bullish trend, neither is it moving in a bearish trend over here. So you can say here, see no trend, like that. Now, having looked at the interpretation of trend lines there, we move on and look at the prediction of the market using the Dow theory. We can look at the Dow Jones Industrial Average and the Dow Jones Transportation Average right here. So this, we've actually done the uptrend, downtrend, and no trend there. So moving on, this Dow Jones Industrial Average, Dow Jones Transportation Average provide an indication of when to buy a security and when to sell a security. So the best way to demonstrate this prediction of the market is to use a graph. So I can use this part right here. Draw it like that. Not be very perfect, but at least I'm trying my best. Prices. Yeah. And here we have time moving like that. Probably that line may not be the best. Let me just redraw it again. Trying to consider that. Yeah, I think that's better. This is time. Yeah. Now, the Dow Jones Industrial Average is usually much higher. It has got generally higher prices as compared to the Dow Jones Transportation Average. Now, we can be able to just draw roughly how the Dow Jones, it's just like an indicator of when to buy securities and when to sell securities, like that. So we can say Dow Jones Industrial Average Index. Now we can have, probably can have something like, this is when to buy and when to sell. Probably it may not be the best. I can just rub somewhere here and maybe change it a bit. Like that. That. Yes, let's put it like that. Draw lines like that. Also like that. So if we can be able to just draw the Dow Jones Transportation Average right here, like so. So this should be somewhat like, should have been actually at the bottom part, yes, like that. Like that before, now it rises again like that, something like that. So they almost follow each other the same fashion here. So this should indicate a sell signal, and here I'll be able to just draw somewhere like this, like that. This can be you can do it like that. Sorry, like that. Yes, this is Dow Jones Transportation Average there. Right here indicates us, right, this point here indicates sell signal, and here as well sell signal, that. Meaning what? Meaning that investors have have an indication that the market is actually going to start moving down. That is what you need to understand. That this is a sell signal over here. You sell the securities that you already have. Or if you're intending to purchase, you don't consider purchasing the security at that moment. But however, after a little while, after some period of time, remember this is time like that, after some time, what happens is that the Dow Jones Industrial Average and the Dow Jones Transportation Average provide an indication of when to buy and sell. At this point is where you should have a buy signal, right? That part over here, this part here, buy signal, buy signal, there. So these indicators provide some guide to investors as well as analysts when to buy securities and when to sell the securities. When to buy, you buy low, you sell high. You buy securities at a low price, at the lowest price possible, then you sell once the securities actually reached a very high price there. Now, the Dow Jones Industrial Average, there are times when you find that if the Dow Jones Industrial Average is moving down and the Dow Jones Transportation Average is moving up in the opposite direction, then there is no indication of any trend. So I need to probably highlight that in writing right here. So I can highlight that by saying that when the Dow Jones Industrial Average, or I can put it in full, I think the best thing is to put it in full like that. Dow Jones Industrial Average, Jones Industrial Average, DJIA, is rising, and the Dow Jones Transportation Average is falling, rising, falling. There is no trend that exists there. So we are saying, if you have a hypothetical graph like this, you find the Dow Jones is falling like that, Dow Jones Industrial Average is falling, and the Dow Jones Transportation Average is rising like that, then there is no indication of a trend that exists there. So there you should not be able to infer anything, and you should be able to probably maybe hold on a bit so that the trend can be able to exist. However, when the DJIA and the Dow Jones Transportation Average, DJTA, are both rising, buy the security or asset. When the contrary occurs, sell into brackets, do not buy the security or asset. There. This is just a simple summary of this diagram over here, like that. Now, having looked at the prediction of the market using the Dow theory, we can move on and look at the support and resistance levels. Support and resistance levels as used in technical analysis. Now here probably I move on to this other side so that I can be able to draw a very nice graph over here that can be able to explain to us the support and the resistance levels. And the graph that I will draw over here will be indicative of when we as analysts or investors should consider buying once we see or identify such a trend. So we can be able to draw it like so. That price, time, that, and we can draw just something like, say, that. Can probably put it something like that. And probably this should rise a bit like that. So for us to understand the support and resistance level, we just need to know, just from the terms like that, we know that the support level is down there because it supports and prevents any further downward pressure movement there. So this is the support level, and this is the resistance level. You can say the support level supports any further downward movement, supports level supports any further downward movement in security prices and restricts movement beyond that point. There, restricts movement. So we are saying the support level. So it exerts some downward pressure. It tries to prevent that further downward movement in security prices, and there, that is what we're saying is the support level. The resistance level is the opposite of this, and we can say that the resistance level prevents any further movement upwards of security prices, prevents any further movement of security prices beyond a specified level there. So that is the support resistance level explanation right there. Now, the support and resistance level can provide an indication of trends as well. So if we have, since we're doing support and resistance level, I can use this space over here. If we have support and resistance levels moving like that, we can be able to say that this is a channel moving upwards there like that. And if we have support and resistance levels now, of course, moving like that, then we can see that that is in fact, a wedge. What you're saying is a wedge like that. So the prices are moving very erratic at the initial stages, but now as they come down to the most recent prices, it actually concentrates at one point there. So that's an indication that the security prices are actually moving down there. Now with that, we move on to now the chart patterns. With the understanding that we have done under support and resistance levels, we try and identify which chart patterns can be used to try and identify trends as used by technicians there. So we can have something right here. Chart patterns and the interpretation. Interpretation. Yeah. Chart patterns and interpretation, what we will be able to look at, we will first of all indicate a no trend, a bullish trend, and a bearish trend. That's what we need to understand. We may be repeating some of the items we've looked at, but that is what the technicians actually want us to do. They want us to understand what the principles behind the use of graphs and charts there. So we can have that and that here. So we can indicate that this is a no trend, a no trend there. And then B is a bullish trend. We can be able to draw how a bullish trend looks like. Right, just below that, we just draw a bullish trend. This is prices, time, like that. Prices, time. So we have now the same, rather apologies, this is bullish trend. So we expect something like that. And then we can draw, this is B, bullish trend. There. C, we can say bearish trend, which is moving down. So we can just draw the graph right over here. Bearish trend. This is prices against time. So now we can draw something like that, where we have the security price or asset price moving down like that. So this is C, bearish trend. Bearish trend. Now once we've looked at those trends like that, here we cannot be able to interpret. Remember, it is chart patterns and interpretation. So here we cannot be able to have any interpretation. The interpretation here is a bullish trend, so we should be able to buy. Right over here, buy is the interpretation. Over here, sell, sell or do not buy. Do not buy is the interpretation right there. We can also move ahead and look at configuration or confirmation of a bullish trend. We can use now another graph here to just continue from this. Confirmation of a bullish trend, confirmation of a bearish trend, and no confirmation of a trend there. There, I can use that. I can still draw another one down here, so that all that will be left is for me to just indicate the trend there. So D, confirmation of you can say confirmation of a bullish trend, So we have something that moves like that. Then we have like that. Then it moves up in that direction over here. So these are the security prices over here. The security price is moving like that. Then we have that kind of a channel where there is no trend, and then it moves up in that direction. That is confirmation of a bullish trend. Then E here is confirmation of a bearish trend. Where we are saying it was moving like this, then we have the channel existing like that, and then it moves back down in that direction there. Confirmation of a bearish trend. Yeah. Now, since we've already indicated a no trend over there, there is no need to try and draw a graph that indicates confirmation of a no trend. All we need to move on and look at is the reversal of a bullish trend, the reversal of a bearish trend. So let's look at how they look like. Here, I have this graph drawn properly. Draw another one right here, just below it. That. This is price. I not indicated on these other ones over here. This is price still against time. This is also price against time. It's always good. As an analyst, you need to also always be complete in terms of whatever you're doing. Whether it's doing corporate finance, you're supposed to always be complete and incisive. So now we're just trying to see, now that is E, this is F, and we are saying confirmation of a reversal rather. We're looking at reversals. We've already done the confirmations. Reversal, of a bullish trend. So we have the security price moving down like that. We have no trend existing at that point, and then we find that the security price starts moving in that direction like that. So that is reversal of a bullish trend. It was moving down, then we had a no trend market right over here, and then it changed direction and said moving up like that. Now reversal of reversal of a bearish trend. Now this one will have a reversal of a bearish trend. EF. This is G, reversal of this is bullish trend. This is bearish trend. bearish trend. So that means it's going to move the opposite like that. So security prices was moving like that, We had the channel existing or no trend existing there. Then it came back and went back down like that. Reversal of a, rather, it should be the other way around. Reversal of a bullish trend. Bullish means moving up. This is reversal of a bearish trend. Bearish. Apologies. This is bearish. Bearish trend. This is reversal of a bullish. This is moving up is always bullish. Then it comes down like that. This is reversal of a bullish trend like that. So this is price. This is time. There. Moving on, we have a wedge. A wedge. And a wedge looks like so. This is still price. This is time. Now you have the security prices moving like so. You have the security prices moving like so, where you'll have it moving, narrowing down towards a point like that. Have it move in that direction over there as a wedge. Remember, a wedge is something that looks almost like that. So we find security prices being very erratic over here, but now concentrating towards my point there. That is what you're saying is my wedge. That's G, this is H, wedge. Now here, we are saying that, especially when it's like this, we are saying that even if it is bearish like that, the security prices become less and less erratic over here. The interpretation can be that the security now is being less traded, is not being traded as much as possible. So that is what you're saying is a wedge there. Now, having looked at the chart patterns, now let's look at something else, and we look at reversal patterns there. So reversal patterns. Reversal patterns, apologies. Patterns. Now, under reversal patterns, what we have, we look at head and shoulders. And shoulder patterns. There. Just use a graph here. So the head and shoulders will just be like that. Then you have, this is price, time, there. So you find these represent the head, the shoulders, sorry, shoulders. These ones, and this represents the head. So it can be an indication of either downtrend, or it can be an indication of a head of an uptrend, especially more so when you have the inverse head and shoulder patterns. So the inverse head and shoulder patterns will indicate an uptrend there. We can say inverse head and shoulder, inverse head and shoulder. So inverse head and shoulders, just very quickly. It's just the opposite of that. So you have that. This is now, these are the shoulders, and that is the head, like that. So you can see that this is the pattern is moving like that. So this one is going to be a bearish trend, or it's almost going to be a reversal. And what we had looked at before, reversal, so it's actually a downtrend, then it changed back, it moved and back up like that. Next one is a double top formation. Double top formation. Over here, what we can do, right in a problem, maybe a very not so big diagram here. This is price, time, price, time, like that. So double top formation, if you have a line like that, in that form, so you find the security prices, let me put it like so. So you find the security prices moving like that, then it has like that. You can be able to now demonstrate that here is actually a double top formation like that. So it's double top at the top like that. So we're saying over here essentially we have the support component existing right there, so it can be able to just reinforce your decision that is going to be an uptrend there. So that's a double top formation there. Now to conclude this lesson, let's look at very briefly the trend lines. The trend lines are not any new to us right now in this topic review, because we've already looked at the Dow Jones Transportation Average and the Dow Jones Industrial Average. So let's very quickly look at trend lines. Trend lines there. So for trend lines, we just have the following. We just need to understand what each trend line indicates in terms of uptrends, downtrends, and like that. So if you find security prices moving like that, and the general trend line is moving like that, in the Dow Jones Industrial Average moving like that direction, that is a bullish trend buy trend. That's when you're supposed to buy. Then if it's moving in the opposite direction, I can put it on that graph like that, and you're saying that the trend line is moving in that direction, and we say it is bearish trend sell security like that. Here we still have prices, and here we have time. That shows continuity in the line there. Having looked at the trend lines, now we can also try and have something like that. There is no indication of any trend line or any direction of the movement in security prices there. So what can we infer from that? We can infer nothing from that particular line. This particular line over here, we cannot be able to infer anything, because there's nothing, there's no movement in any particular direction, either up or down. Having looked at that, we hope that you have enjoyed this lesson. We hope as well that you will be able to join us in our next lesson, where we will still continue looking at technical analysis. Thank you, and God bless you. Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Gwiri. I'll be taking you through residual income valuation. Under residual income valuation, what we will specifically look at, so we'll be looking at residual income valuation. So what we look at under residual income include, for one, we will look at the definition. Then we will look at the application of the definition of residual income. So we'll look at an example there. Then we will move ahead and look at the concept of economic value added and market value added. There we will write the formulas for the two components. So in other words, we're saying it is going to be EVA and MVA, economic value added and market value added, right there. Then we will move ahead and look at an example that will be able to explain this. So we look at an example that computes the economic value added and the market value added. Then we'll look at the uses of residual income, valuation there. Once we've looked at the uses of residual income valuation, we will move ahead and look at the intrinsic value of common stock based on residual income. So the intrinsic value of common stock there. So we will be able to end this first topic review by looking at the intrinsic value of common stock, and then we can be able to now build on this concept by looking at lesson 2. Yeah. So we begin by looking at the definition of residual income. Definition. So we can say that residual income valuation is the fourth valuation tool that is gotten by getting, that's repeating myself, gotten by getting. We cannot say gotten by getting, we say is gotten by determining the net income and deducting a charge that is due to equity shareholders, or what you can be able to say common shareholders there. In traditional accounting sense, it is believed that once we have the sales value like that, with less cost of sales like that, so we have the sales value there, less cost of sales like that, we'll be able to achieve the gross profit like that. Once we have the gross profit with less expenses like that, then what we get? We get the net profit. Net profit there like that. So in traditional accounting sense, once an investor assesses the net profit component like that, then it is believed that the company is profitable. Taking it forward from the investments and financial analyst perspective, we try to provide a compensation that is due to common shareholders, because the common shareholders have actually provided funding to the organization, so they need to be compensated something. That is what you're saying, deduction or deducting a charge that is due to common shareholders there. So that means we need to deduct now what is due to common shareholders over here, and we can be able to see whether the value will either be a positive or a negative like that. If we have a positive value, then we are saying that makes economic sense. After compensating the common shareholders like that, then we are saying we achieve a positive value. Then that indicates that the residual income is effective there. Now, if we achieve a negative value, it means that once we achieve the negative component of residual income, we are saying that it is not good for the firm, because after compensating the common shareholders right over here, then you are achieving a negative value. So in the truest sense, from the financial analyst perspective, or for the investments and financial analyst perspective, we need to compensate the shareholders what we call an equity charge. This is an equity charge right there. So we can explain it further and say the charge due to common shareholders is called equity charge. It's called equity charge, which is gotten by it is gotten by cost of equity times value of equity. That's how we get the equity charge. We get the cost of equity, then we get multiplied by the value of equity there. Now, having looked at the definition right there, we now need to look at an example that will be able to demonstrate the residual income in perspective, or put the residual income in perspective there. So we have an example here. M company distributes fruit to grocery stores in large Kenyan cities. The book value of its assets is 1.4 billion, which is financed with 800 million in equity and 600 million in debt. Its before tax cost of debt is 3.33% and its marginal tax rate is 34%. EMS has a cost of equity of 12.3%. EMS abbreviated income statement is shown in the following figure. So we have the figure demonstrated to us there, where we can be able to see the EBIT is 142 million, the less interest expense, then you get the pre-tax income there of 122 million, less the income tax expense of 41,480, then you can be able to get the net income component of 80,520,000. Determine whether M is profitable by calculating the residual income and explaining its relationship to reported accounting income there. So what we need to do, we need to determine the formula for residual income. So we say solution there that residual income, RI, is given as net income less equity charge there. So the equity charge is gotten by cost of equity times the value of equity. Let's see if we've been given the net income. Yes, from that table there, we can be able to see that the net income is 80,520,000. Now we need to get the equity charge. The equity charge is just given by cost of equity, which we've done over here, times the value of equity. So let's see equity charge computation. There. So cost of equity is how much? We are saying the cost of equity is 12.3%. 12.3%. You can see we've already been given that value there. And the value of equity, or the equity component, so value of equity is 800 million, like that. So we say 800 million multiplied by 0.123, how much do we get? So we have 800 multiplied by 0.123, we have 98.4 million. So we have 98.4 million right there. Coming back to this formula here, we say RI is given as net income. The net income given to us there is 80,520,000. So it's 80,520,000, like that. Then you less 98,400,000, 98,400,000, like that. That's what you're saying. 98.4, 98,400,000, like that. How much do we get? 80,520 less 98,400,000. We get 17,880,000 there, negative. So negative 17,880,000, like that. So we are saying that even if the company may have made a net profit or a net income of which is positive of 80,520,000, we are saying it may not be economically viable because we, after compensating the equity shareholders and the equity charge, we are saying that now we'll be able to get a negative value right there. So that means that in the traditional accounting sense, it seems profitable there. But after charging equity charge due to the equity shareholders, we receive a negative value there. So it may not be a good thing or a good idea. It may not really be profitable in the truest sense based on the financial analysis side. So now we have done that example right there. Now let's look at economic value added and market value added right here. So this is what we're looking at right here. Now, the economic value added or EVA is given as, let's just first of all, let's put that like that. So the EVA or economic value added is given as net operating profit after tax, like that. Then you less weighted average cost of capital, the product of weighted average cost of capital multiplied by the invested capital. Invested capital. There. Where EVA, no part, work, invested capital, economic value added. Value added. This is net operating profit after tax. Profit after tax. Then there is the weighted average cost of capital. Weighted average cost of capital, like that. Then this is the component of invested capital, where we are saying it is the net working capital, plus net fixed assets, plus net fixed assets. That is how we get the invested capital there. As well, to get the invested capital, we can also put a hyphen there and say, or, right there, or, put a hyphen there. We can be able to just get the long-term debt. Long-term debt. We add the component of long-term equity or equity component. Equity capital. Long-term debt capital plus the equity capital, long-term equity capital or the equity capital, like that. So these are the two forms of how you can be able to get the invested capital there. Now, we look now at the market value added. So market value added. MVA is given as market value market value. Then you less the invested capital component, invested capital component, like that. Plain and simple. Now, to try and demonstrate this, let's look at an example. Now, we have V company reports a NOPAT, or a net operating profit after tax, of 2100, a weighted average cost of capital of 14.2%, and invested capital of 18,000. The market price of the firm's stock is 25 per share, and V has 800 shares outstanding. The market value of the firm's long-term debt is 4,000. Calculate V's EVA and MVA. Now, we start off by looking at the EVA solution. EVA, or economic value added. We have NOPAT minus WACC times invested capital, like that. That is how we get the EVA. Let's try and identify if we've got all of the inputs. Do we have the net operating profit after tax? Yes, we do. It's 2100. So NOPAT 2100. The WACC, the weighted average cost of capital, I can see, yes, it's 14.2%, 0.142, and then invested capital. In this case, we have been given directly there, 18,000. Like that. Now, putting it all together, we have 2100 there, minus the component of WACC, 0.142, which you have there, then multiplied by 18,000, which you're saying is the invested capital there, multiplied by 18,000, like that. How much do we get? So we have 0.142 multiplied by 18,000. We get 2256. Then we have 2100 minus 2256, 456. 2100 minus 2256, then we have negative 456. Negative 456. You can put this in brackets to indicate a negative value there. That is the economic value added. Now, we look at the market value added. We said the market value added is just gotten by the market value, then you less the invested capital right there. So MVA, we have the market value less invested capital. So the market value is how much? The market value includes the component of debt. So the market value of the company, we need to get the equity component. So we are saying it's going to be market value is going to be 25 multiplied by 800. Yes, we can see the 800, which you're saying V has 800 shares outstanding. So 800. So we're getting the market value of equity. Then we add the component of debt to get the market value. So the market value of debt, we've been told, is 4,000. Yeah. So how much is the market value? So 25 multiplied by 800 is 20,000 plus 4,000. So it comes to 24,000. That. Now, once we have that, we just get 24,000 minus the invested capital. We've already computed the invested. We've already been given. Sorry, not computed. We've been given the invested capital as 18,000 there. So MVA is given as 24,000 minus 18,000 there. So 24,000 minus 18,000 looks like 6,000. Yes, it's 6,000. 6,000 there like that. So that is how you compute the economic value added and the market value added there. So having looked at that, we've done an example already over there. Now we need to move on and look at the uses of residual income valuation. The uses of residual income valuation. Residual income valuation. Uses of residual income. Now, residual income, remember what we defined at the beginning. We had said residual income, or RI, is given as the net income less the equity charge. Equity charge right there. And the equity charge is just equity charge. We had said is just the cost of equity times the value of equity. That's what you're saying. Trying to relate this with the uses of residual income, we are saying the first use is that RI, or in full residual income, is used to evaluate executive compensation. Residual income is used in the investment industry to evaluate executive compensation. The second use of residual income is to try and evaluate managerial effectiveness or assess managerial effectiveness. Residual income is used to gauge managerial effectiveness. Like that. So those are the two major uses of residual income like that. Now, having looked at the uses of residual income valuation, let's move on and look at the intrinsic value of common stock. Intrinsic value of common stock. Intrinsic value of common stock. Now, we had already defined what intrinsic value is. Intrinsic value is the value that you believe as an analyst the value of, say, a share like KCB should be at. So, for example, if the value of KCB based on the forces of demand and supply, which is yielded by the Nairobi Securities Exchange, is saying it is 42 shillings, that is the current market price. But if you use, say, for example, DDM, discounted dividend model over there, which you're saying is D0 1 plus G over R minus G, and you determine that the value of KCB, for example, should be now at 43. Rather, let me just use a much more realistic example, maybe say 45, like that. So we said the rule of the thumb is if the current market price is greater than the intrinsic value is the one that you believe the value of the share should be, then it is overvalued. And you should not consider buying that security. But in this case, we are saying that the intrinsic value is greater than the current market price. So it is undervalued and you should go ahead and buy that security there. So in residual income, or applying that understanding to residual income, we are saying that we will be able to just come up with a formula, or we formulate a formula that is going to be applicable in trying to determine the intrinsic value there. So we are saying that residual income can also be gotten by getting the earnings like that. Then you less the product of the required return, like that, and the book value of equity. Book value like that. Not necessarily book value of equity, just the book value component like that. That is how you get another form of getting the residual income. As well, we can also get the residual income if we have the required return on equity by trying to get the ROE multiplied by, rather, not multiplied by, we less, sorry about that, we less the required return, then we multiply by the book value. Book value like that, where ROE is residual, is return on equity, and R is the required return. Required return like that. So once we have those two, when we have the ROE, we have R, and we have the book value, we can also be able to get the residual income. Let's look at an example that can be able to highlight